Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Asian stocks fluctuate as volatility grips global markets. Weak demand for treasuries weighed on sentiment in the US session. German conglomerate Siemens says weak demand for factory automation is hitting returns. More on that and a host of other earnings this hour from Europe. Plus, European gas prices surged to the highest level this year on reports that Ukrainian troops have seized a key gas transit point near the Russian border. We'll check on the opening of gas markets.
Let's take a look at these markets. European futures are lower this morning. We had a really solid session yesterday. Equities popped higher. Looks like we're going to give back some of that this morning. Looks like US futures are a little softer as well. As Anna's already mentioned, the US 10-year auction didn't go well yesterday. We've got a 30-year today. We've also got claims data. Keep an eye on that data. High-frequency data, pretty important right now in telling us what is happening with the economy. So we're watching that very carefully as well. In terms of what we've seen overnight out in Asia, as you can see, dollar-yen, a little bit of weakness creeping in there as well. The yields are lower in the United States. We'll keep an eye on all of this as we work our way towards the opening trade here in Europe. The opening trade, or at least the countdown to it, starts right now. Thursday the 8th. Good morning, folks. Markets still feel pretty jumpy. We saw that terrible auction yesterday in the United States. The market clearly not buying these lower yields at this point. Got slightly lower yields again this morning on the US 10-year, but not by much. US futures are lower. European futures are lower. We've got some claims data coming up a little bit later on. Feels like it's going to be another topsy-turvy session, let's call it that way. Where we end, I think, remains pretty unclear at the moment. Where we open, Anna, is lower.
Topsy-turvy session. You see, I was going to say...
I'm running out of things to say.
I was going to say we've got an alliteration competition going on here because we started with Monday Mayhem, Turnaround Tuesday, Whipsaw Wednesday, Topsy-turvy Thursday. I mean, it's as good as any. So, we'll go with that until the facts present themselves, and then we may revise our topsy-turvy. But that's just a sense of the week we've had. My favourite quote in our report on Markets Wrap this morning is that this week has been very emotional. And it's clear that there have been emotions in the market. That was a quote from Nationwide saying it was emotions driving markets all this week. European stocks do look vulnerable today, though, don't they? Because we actually closed on really strong gains yesterday, and then we saw this big intra-session drop in the United States, driven by the Treasury markets and corporate debt issuance. And so we're vulnerable here in Europe.
I don't think it has been emotional. In fact, I think it's been almost the exact opposite of emotional. This felt like it's been driven by the computers this week. It's felt like it's been driven by...
Well, that's true. The emotions are on the beach and watching the Olympics.
Well, precisely. All the people are away. It's the computers that have been driving this, and it's been the CTAs that have been so long, so many of these assets, because of the low volatility, and they're the ones that are being caught out. Are computers emotional? Well, not yet, maybe.
Maybe they're still working on that emotional intelligence. I was interested, though, in the corporate issuance. We'll get to this later in the programme. 17 companies adding up to the most issuance that we've seen in any day this year, which doesn't really fit with the chilling effect that you can see from market volatility at the start of the week on that corporate issuance. So that's one to watch. And, of course, we'll have to have more conversations about claims because that is going to be the data point of the day.
It is. We're going to be watching that very carefully. It was interesting. I think the corporate issuance probably did also have an effect into the US 10-year auction.
Yeah.
So I think that's something that's worth bearing in mind as well. We've got a whole load of earnings that are out this morning. Doesn't feel quite as busy as it did yesterday, but it's still there's still certain numbers that are worth watching within the story here. Siemens, I've just been speaking to the CEO, Roland Busch, talking about his numbers. He is going to hit, he thinks, the lower end of his recent guidance.
I was confused by, some of the headlines that came out here, because they said the revenue estimates, they were sticking to that revenue estimate of 4 to 8% versus the market's expectation of 3.3. So I thought that sounds quite bullish, but then the story adds a bit more detail that sounds less so.
Well, I think the fact that they're at the lower end isn't great news. The automation story remains a problem. But to your point, I'm really intrigued to see how the stock opens this morning, because the market expectation in terms of that guidance was quite a lot lower, and it looks like the margins have been the top line looks pretty much in line. The bottom line looks okay, so the margins are actually performing reasonably well. They just need to work their way through through this automation inventory story.
Yeah, and as you say, you've been speaking to the CEO, so we'll bring that to the audience a little bit later. A lot of focus on insurers as well today.
Yeah.
We are going to be speaking to the Zurich Insurance CEO shortly, in fact. Profits up there, better than estimates, revenue higher, life business very much in focus. A lot of M&A in this sector, and so a lot to talk about there. And, of course, this is a business that when you see markets volatile, they're big asset owners, so we need to have a conversation about what this means for their holdings.
In terms of what else we're watching, staying in the insurance space, Beazley looks like it's beaten as well. So it looks like it's been a really solid morning for the insurers. Munich Re out with some numbers this morning as well. So Beazley, first half pre-tax profits, beating estimates as well. Deliveroo, I'm just looking for a headline there. Deliveroo's first half gross transaction value pretty much in line with estimates. So it looks like it has come in pretty much in line with estimates. Entain has also beaten estimates as well this morning. So it looks like a fairly solid group of corporate earnings through this morning.
Those sound like some excellent stories for Joe Easton to keep his eye on when he will do that a little bit later on today. Let's just backtrack to the commodities story because this is of interest. During yesterday's session, and we're just getting opening prices on the European trade this morning, so we'll bring those to the audience. But just in yesterday's session, we saw that big surge higher in gas prices, although when we say that, 38 euros, it's not 2022, it's not 160 euros we're talking about here, but it is relative to recent history a high price for gas. Reports that Ukraine got hold of the Sudza gas transit pump or point. This is 3 to 5% of Europe's demand, so it's not a huge amount that comes through here. But it is a reminder, actually, that we do still take gas from Russia. It's not sanctioned, that gas supply from Russia, which is a reminder. We've massively reduced exposure to it and reliance on it, of course.
So this is the Ukrainians making incursions into Russian territory.
According to these reports,
According to these, well, looks like they have got, certainly the reports all seem to suggest that we've got a Ukrainian incursion, which looks like it's designed to pull troops away from other fronts. So we'll continue to monitor what is happening there. The commodity story, to my mind, is copper. Oh, my Lord, we have seen a decline in copper.
Stockpiles.
And if you, precisely, and we saw a big load of stock turning up at the LME the warehouses yesterday. You've got a real glut of copper kicking around. And that tells us a lot about what's happening with the global economy, particularly the Chinese economy right now.
It really does. It looks like the LMEX index, which is a good measure of sentiment around some of these big base metals, that is in danger of erasing its year-to-date gains today. And this is all to do with China demand. It's to do with concerns around the US slowdown. So whilst we're busy watching volatility in markets, I'm not sure, maybe these base metals haven't been all that much volatile. They've just been trending a little bit lower over recent sessions. Copper stockpiles, as you say, that big delivery on Wednesday, really highlighting the extent of those stockpiles, the highest then since 2019 on that particular, on the LME sheds. So we'll continue to watch copper prices. Gas prices not moving all that much this morning, still around that 38 euros mark.
Got a lot of guests coming up. We're going to talk to some of the CEOs we've already been mentioning this morning. The Zurich CEO, Mario Greco, is going to be joining us very shortly. Very strong earnings coming through from that business. Eric Whitens, EMEA Investment Strategy Head at JP Morgan Private Banks, is going to give us a view on what we're seeing with these, let's call them topsy-turvy markets this morning. We'll do the topsy-turvy market turmoil at 7:30 a.m. 8 o'clock, we're going to be joined by Polar Capital Fund Manager Eleanor Lee. Looking forward to that conversation. 8:30 a.m. We're going to be talking about this corporate credit story that we've already mentioned. As Anna said, quite a lot of issuance coming through. Omotunde Lawal. I'm going to get that right. I am going to get that right. I practiced it earlier.
It's good.
I absolutely failed there. Corporate credit, joining us from Barings. We'll look forward to that conversation a little bit later on. It does appear, Anna, that maybe that big issuance story, which has been building up throughout the beginning of the week because there wasn't any, probably took some of the steam out of the 10-year.
Absolutely, and Omotunde has in her notes some great lines around that and the way that the market volatility has played into issuance. So we'll certainly get into that conversation with her later on in the programme. Quick word on what's coming up then in terms of data points today. We've already mentioned the big one, and that is initial jobless claims. 1:30 p.m. at UK time, that is due. We'll have another auction stateside, and given the sentiment read across into other assets from the weakness of that yesterday, combined with the corporate issuance, is certainly a market we're going to focus on. We'll hear from some Fed speakers. Richmond Fed President Thomas Barkin will be speaking later on today. We've got a host of US earnings. Eli Lilly, of course, will be one of those. Maybe we'll just go back to claims briefly then, Guy, because we are continuing to look for cracks in the labour market. And last week we got continuous claims that were at their highest since 2021. If we get another reading like that this week, the market was vulnerable on Friday. Could the market still be vulnerable given the amount of volatility and the lack of emotion and the amount of computers involved? Maybe.
The claims data, I think, is going to be useful, but needs to be seen in context. And that context is a bit like the data that we're getting in terms of the non-farm payroll numbers. There's still some lagged effects coming through from hurricanes. There's still some weather effect coming through. So it's going to be really interesting to see how this data stacks up, or whether or not this is the number that actually gives us a clearer picture. Do we actually get a clearer read this week without some of that noise in it? So that'll tell us maybe more about what is happening within that labour market.
And we'll see if we get that topsy-turvy Thursday as a result. Let us move on to some of the other stories that you need to have on your radar this morning. This week's Taylor Swift shows in Vienna have been cancelled after a terror plot arrest. She was scheduled to perform 3 shows before the tour's final European performances in London. Warner Brothers Discovery shares tumbled in late trading after second quarter results that missed expectations. The parent of CNN posted a charge of $9.1 billion after writing down the value of its traditional TV networks. And Disney is forecasting a mid-single-digit profit decline in the fourth quarter. The company reported mixed third-quarter results, with weakness at its theme parks offsetting its first-ever profit in streaming.
It's interesting, that park story fits with what we're getting elsewhere in terms of the travel story.
That sort of experiential consumer spending boom that we saw on the back of COVID, has that really faded? That seems to be what's coming through in that parks narrative.
And maybe that fits with the Airbnb story, and maybe that fits with the booking story and what else we're seeing, though it wasn't the story we got from IHG. OK, what are we going to talk about next? Coming up, online misinformation has helped fuel riots across the UK over the last week. We're going to discuss the role of social media platforms and what they've done and how they've played a role in all this story. And this comes, of course, amid tightening calls for online safety regulations. We'll do that a little bit later on. Plus, we're going to take a closer look at the European defence sector. Rheinmetall, Germany's biggest arms maker, reporting earnings. It was a beat. We'll find out why and what those numbers tell us. Up next, though, we're going to be joined by the CEO of Zurich Insurance. Mario Greco is coming up next. Really strong numbers out from his business this morning. We'll find out why. You want to join the debate? You want to find out what's going on in these markets? Maybe you can help us figure out what's happening in these markets. IB Plus, BB, TV Go. That's the function. This is Bloomberg.
In this quarter, and after 6 months, we are now already at 3.8 billion euros of a net result. By the way, the highest net result ever we had after 6 months. So very well on track to achieve our full year guidance indeed. Now, the question is, why didn't we increase it probably? Well, I would say that's the typical Munich Re conservatism. We are cautious until the very end. And you know, the third and the fourth quarter are very cut heavy in our planning. So therefore, we thought, let's give it another quarter and see how the development goes, and keep the guidance unchanged for now.
CFO of Munich Re, speaking to Tom McKenzie a little bit earlier on today. Q2 earnings beating estimates. Let's talk about another insurance company, different space. Still an insurance company. Zurich Insurance out with numbers this morning. Half-year profits surging. A 7% gain in profit for the first half of the year. That beat estimates. It's increasing revenue, seeing increased revenue coming through from its life businesses. Joining us now is the Group CEO, Mario Greco. Mario, it's always a pleasure to speak with you. Looks like the fee business has done really well, and that's a standout story with these numbers. How sustainable is that?
We believe it's very sustainable. This has been a constant development over the past quarters and years, and it is accelerating. And we trust and we're confident this will continue further. More than 50% of our profits are generated by fees, which are immune from market volatility and fluctuations. And this is a very strong characteristics of our P&L and balance sheets.
What's happening with the rest of the business?
On property and casualty, we have a very strong performance in the commercial portfolio, which is 65% of our property and casualty business. There, the margins are even expanding. So we're very pleased with that. And again, we're confident that we'll be able to run the commercial business with higher margins over the next quarters and years. The retail business is suffering, especially in Europe. And this is a combination of still inflation. Cost of claims is still quickly growing. And also, especially in Germany, frequency changes. The frequency in Germany of accidents has been much higher than in the past, and we're still trying to understand what's special about Germany.
Talking about the cost of those claims then, good morning to you, Mario. You're talking there about the European context. What are you seeing in the US? Because I think we've talked to you in the past about the cost of meeting claims in the US market.
Yeah, US has been faster in correcting itself. So the price increases have been very significant, but also claims actions have been quite effective. So I see a decline of the price increases to a normal, standard, moderate price increases situation in the US market for motor especially over the next quarters. Homeowners is a different story because that's weather related. And as long as the weather behaves, which it probably will not, the price increases in homeowners also will tend to moderate. But I do expect that the weather, even in the US, will remain the biggest issue for the price of the policies, of the coverages.
Can you tell us a bit more about weather-related insurance then, Mario, at this point, and the way that it's changing and climate change perhaps is changing the types of business that you're writing? For example, less agricultural insurance, more flood insurance, or that kind of dynamic. Is that something you're seeing? How widespread is that?
I think the most important priority for all of us, insurance companies included, definitely for Zurich, is to work on preventing the consequences of these claims. Otherwise, the cost of the claims will continue to rise, and it will probably, in some cases, will become socially unaffordable. So prevention is the most important thing, and we have been working a lot on that with customers, with governments, with communities, to avoid the consequences of these weather events, because they're happening and the frequency is increasing and they will continue to happen. And so the best that we can do is to limit the effect and the consequences by anticipating them.
Talking of volatility, not weather-related volatility, but market-related volatility, what have the last few days been for you? You're a long-term investor, but you're a big asset manager. Have you seen any impact in terms of your portfolios? Do you anticipate this volatility continuing? And if so, what impact could that have?
Yeah, we do expect volatility to continue in the markets. Markets had a wonderful run over the last 6-7 months. And as always, markets are cyclical, and they not only move up, but they can also move down. Also, we have a big event happening in November in the United States, which is going to shape financial markets and the geopolitical balance of the world. And we believe that up until November, there will be volatility in the financial markets, as there will be volatility in the political news, and there will be risks. And so we're prepared for that. We do not have an impact yet because what happened over the past days hasn't been that significant. But we're prepared to have now a couple of quarters of pretty elevated volatility in the financial markets.
So if you're looking for more volatility, Mario, and you mentioned there market volatility and the geopolitics and the political events in the United States, thinking about those elections, what is at stake for a business like Zurich in this election? Tell us how you and the rest of the C-suite watches developments in Washington and how you think about those.
I think there is a lot at stake there besides the business implication, because there is a political balance and the geopolitical equilibrium which needs to be redefined over the next years. And that, of course, depends on the result of these political elections. This is a very special year. We had elections almost everywhere in the world. Some of these elections have been quite important, and we even had surprise election calls like the one in France. I think the combination of all of them by year-end will make us better understand what kind of balance will be achieved in the next years. And this will eventually have implication on the business.
Mario, there's been a lot of speculation around who you're talking to about M&A and possible acquisitions. Clearly, you're not going to tell me any names. You're not going to give me any clear guidance. But give me a kind of broad guidance. How are you thinking about M&A at the moment? Which sectors of the business are you looking at in terms of bulking up on? Is this bolt-on acquisitions? Is this bigger acquisitions? What's the strategy? When you sit down and think about this, what are you talking about?
Yeah, look, we have not changed at all our approach to M&A. M&A for us is a tactical mean to achieve our targets if there are opportunities in the markets. And we have some strategical priorities, like, for example, growth in Asia and the development that we recently announced in India is responding to that strategical priorities. Other than that, we're very consistent, and it's very easy to find in our actions a confirmation of our principles. I mean, we will continue to be tactical. So if there are convenient opportunities, we clearly have the capital and the cash position to chase these opportunities, or we will continue to grow our business, especially in Asia and in general in the emerging economies. But we continue to build typically on strengths that we have.
OK, you talk about being tactical. And you mentioned earlier you see market volatility. Do you think that market volatility could increase the tactical opportunities that present themselves to you?
I don't think so. I think it's just the opposite. If there is a lot of volatility and if there are perceived risks in what's going to happen soon or next, you want to be more cautious and more conservative. I think it's just the opposite.
We recently saw this takes us into different territory, Mario. We recently saw that CrowdStrike outage having a knock-on impact on Microsoft, and a lot of people asking about, a lot of money was perhaps lost, business not done that day, and people asking how insurable that kind of loss is. What are you thinking about that kind of risk at the moment, and how much you will do business in that space?
We have been very concerned about cyber risks and expanding, growing in cyber, because we saw that the connectivity of this world will create events which can have a profound and painful impact on the insurance sector. So our exposure has always been very limited, and we will continue with that. I have also been quite vocal in saying that eventually cyber will need also to have a government contribution, because the insurance sector cannot alone take the burden of it.
Mario, final question. We've been asking this to pretty much everybody we've been talking to recently. There is growing speculation that we're going to see a recession in the United States, that we're going to see potentially the global economy rolling over. Do you see a recession in the near term? How big a risk could that be?
No, this is not at all the base case that we have. We don't see a recession coming soon or coming. Actually, we think that the economy is still strongly set. There are underlying trends which are quite important, which are going to move GDP and labor in the Western economies. There is a huge transformation of the economies undergoing. There is a change in the supply chain organization around the world. And everything pushes in the direction of possibly an inflationary basis, which the central banks have fought over the past years with some success.
Okay.
We don't see a recession coming.
Mario, don't see a recession coming. Mario Greco, always a pleasure. Thank you very much indeed, sir. Zurich Insurance Group CEO. Eric Whitens is going to be joining us next. We'll talk about these markets. That's next. This is Bloomberg.
Welcome back. 30 minutes from the start of opening trade here in Europe. Let's have a look at the futures picture then yesterday. We were whipsawed during Wednesday's session, certainly stateside. Really strong gains, up by more than 2% at one point, unwound to finish down 0.8% on the S&P. So we are vulnerable here in Europe as a result, as some of these markets in Europe closed whilst the US was feeling in more of a good mood. That said, looking ahead to US futures, they look a lot brighter than they did just an hour ago. Nasdaq futures up 0.4%. Overnight, we saw some geopolitical fears, tensions around the Middle East that weighed on sentiment in those futures, but now that seems to be ebbing away just a little bit. So that's what we see then, Guy, in terms of the futures picture for equities, the bond markets in our minds because of issuance and because of the way that the week started.
Yeah, big start to the week, obviously. Bonds benefit, people pile in. Yesterday's 10-year auction didn't go too well. We've got a 30-year auction coming through in the United States a little bit later on. Bonds broadly this morning looking reasonably well bid. We're going to keep an eye on the claims data a little bit later on in the United States, which will give us a handle on what is happening with the labour market, maybe in a little bit more detail. So a little bit of calm maybe returning, but it's early.
Yes, and let's think about where we go then on the underlying growth story out of the United States. We heard just yesterday from the former New York Fed president and Bloomberg opinion columnist Bill Dudley.
When market sentiment deteriorates, that can be self-reinforcing. People start to pull back on hiring. People pull back on spending. Next thing you know, the unemployment rate hasn't gone up 0.5%; it's gone up a full percentage point or two percentage point. You're in a recession.
Former New York Fed president and opinion columnist here at Bloomberg, Bill Dudley, then. Let's get the views of Eric Whitenis, EMEA head of investment strategy at JP Morgan Private Bank, joins us on set today. Very nice to see you, Eric. Thank you for coming in to visit us. So we just heard from Bill Dudley. He's clearly concerned about recessionary signals in the US. We spoke to Mario Greco of Zurich Insurance, has good oversight globally of his world. His base case is not a recession in the US. How nervous are you about that prospect?
Not too nervous. We're more optimistic, perhaps, than most out there in the market as we think about the prospects for the U.S. economy and the risk of a U.S. recession as we look ahead. There's definitely been a tremendous amount of focus on indicators such as the SOM rule and the increase in the unemployment rate in the U.S. on a short-term basis and the overall magnitude off of the lows, as Dudley was alluding to. But there are some counterbalancing factors there that help alleviate some of the concerns that we think are reasonable to have, such as the fact that there's been such a tremendous increase in supply. So the increase in immigration in the U.S. in recent years is a big part of why that unemployment rate looks perhaps a little bit artificially high to us, so it isn't causing us great concern. Furthermore, if we look at real-time oriented data, such as where are JOLTS layoffs, they're not very high. If we look at how often are C-suite executives mentioning an intention to do layoffs going forward, also not so high.
Okay.
And CFO optimism has also been trending higher. So there are a lot of positives that are out there that I think counterbalance some of these recessionary fears.
So maybe you think the markets overdid it then at the beginning of the week when we saw all of that mayhem on Monday. What kind of landing do you think markets are priced for now? Maybe still a soft landing then, but maybe a little softer than it was, if not a recession?
We're in the soft landing camp, and I think that the yen carry trade oriented unwind that drove that extraordinary round trip in volatility Monday is a period of time that we'll kind of maybe go through for the next coming days and maybe even weeks, but is most likely to be a temporary phenomenon. I mean, if you think about the round trip that the VIX equity volatility index in the U.S. did, it basically in a 5-day period moved from about 15 to 65 on Monday and now finds itself back down closer to 30. So as some of those levered positions out there in the market are unwound, markets should focus more so on economic fundamentals, which we think look more sound than some of these panicky fears that the market has shown.
If the Fed goes 25 bips in September, is that soft landing? If the Fed goes 50, is it hard landing?
We're looking for sequential cuts of 25 basis points in September, November, December, and on a quarterly pace in 2025.
Yep.
The market has been kind of swinging back and forth in terms of how aggressively it thinks the Fed will start its interest rate cutting campaign in September. Yep. Just the other day, it was pricing in north of 50 basis points. At the moment, closer to 40 basis points. Whether they start with 50 or 25, we think that the directionality is most important here. And when a central bank indicates that they're going to start to make monetary policy more accommodative, the concept of the Fed put comes into play for markets, and that tends to be supportive from a risk standpoint, and that's a positive.
It is, but the signaling will be more. The signaling will. You're sounding quite confident. And I'm wondering what will make you rethink that confidence that the US economy is heading for that soft landing. Because this is a debate at the moment. Do we get a soft landing, or is it something that we need to worry about a little bit more? Risk assets do well in the soft landing. They don't do well in the latter, in a hard landing. So if you get 50, will you revisit, it doesn't sound like it, revisit your view that we're still in a soft landing camp?
We'll keep an eye on the consumer. To your question about, what might cause you to have a greater degree of concern, there's been a little bit of softening there. But overall level of corporate earnings have been coming through. We're well north of 10% in terms of this earnings season overall. We printed a 2.8% GDP number for the last quarter. We think there's good prospects for continued spending and overall economic activity. Manufacturing numbers have slowed a little bit in the U.S., but the recent services ISM number, which is even more important than manufacturing, had a notable upside surprise, north of 51. So we see a good amount of positives that more so point to an economy that is slowing a bit and not full-blown decelerating enough into a recession.
It sounds like you're not going to read too much into the signal. I think Guy's talking there about what signal it'll give the markets. If the Fed is willing to go 50, is that panicky?
Not necessarily, because here's one way to think about a potential cut of 50 if we see that in September. If the Fed had that softer jobs print that we just got last week, when it had its most recent meeting, they maybe would have done 25 then. So if we end up seeing 50 in September, you can sort of think of that as a 25 plus a 25 catch up a little bit. That's acknowledging the fact that they can start to ease monetary policy. As a reminder, headline inflation in the U.S. got to north of 9% not that long ago. We're all the way back down to about 3%. The inflation battle has largely been won. So there's kind of no reason at this point for the Fed not to make monetary policy more accommodative.
OK, that's really interesting. Inflation battle nearly been won. That takes me nicely on to my next question. And I want to bring in here some comments that we had from the RBA governor. Let's just have a little listen to some of the context around the recent rate decision there.
The board doesn't remain vigilant to upside risks on inflation, and it won't hesitate to raise rates if it needs to. Now, I know this is not what people want to hear, but the alternative of high inflation is worse. It hurts everyone, and I think everyone sees that.
The RBA Governor, Michelle Bullock, speaking just days, of course, after Australia's central bank kept interest rates on hold, but gave this hawkish line that they'd thought about hiking interest rates. You talk in the US context then, Eric, about how the inflation battle has been won. And I'm not sure, I don't want to complicate things by adding in the RBA and all the sort of idiosyncrasies that go with that, but I wonder if it does tell us anything about possible risks to inflation, upside risk. We were talking a lot yesterday about shipping costs and about pricing power from anything from Disney to Caterpillar. I wonder really how much confidence we do have around that inflation trajectory.
So we think that the overall pattern has been encouraging, and it's largely been a global phenomenon. But you make a relevant point in terms of shipping. We've had all the disruptions with the Houthis and the Red Sea, and the degree to which ships from a global transport capacity continue to swoop around the southern tip of Africa. If that has to continue, then that does portend pricing costs that eventually are passed on. So when people point to geopolitical concerns, they're often overstated in terms of their market impact. However, if they have a continued and more tangible impact on things such as commodity prices or shipping costs, it could become more of an issue. But for the most part, we see the global economy and the shipping industry largely managing that.
Let's get back to the markets and kind of what we've seen this week. Monday, market hits the panic button. VIX goes shooting high. You've already mentioned that. Does the VIX come back down to where it was before into an environment where it's very easy to take risk? Or do you think we're in an environment where risk is going to stay, where volatility is going to remain a little bit higher, risk is going to be harder to take, and therefore it's going to be hard to push risk assets up?
So 65 was a bit of an arguably short-term silly number, I would suggest. But I would also take the other side, and you kind of look at that chart that you guys kindly just brought up. I would argue that it was at a bit of an overly complacent level for quite some period of time.
That's what I mean. So do we get if it was overly complacent before, do we go back to that? Because it was great for the CTAs to take a lot of risk on board and keep buying the market.
I think a healthier level for the VIX would more so be in the teens and low 20s and getting some of that back and forth movement in markets. which, as a refresher, is a more normal state of affairs. I mean, the rally that we've had since the October lows in the U.S. to the most recent highs was about 38% in just 9 months. Then we've had a pullback that almost hit 10% on an intraday basis on the S&P. That's actually quite normal. Markets tend to have back and forth movements. The average intra-year decline over the course of a market cycle, or sorry, a market year, is about 14%. So it's more reasonable to have back and forth movements in markets, and that's perfectly okay.
In amidst all of that volatility, then, some of your clients no doubt want to hide out in some longer-term assets and longer-term investments, Eric, and you mentioned infrastructure, and a number of people do. Are you managing to find areas of infrastructure that are very nicely uncorrelated to what else is happening in markets, if that's what you're looking for?
We are. We genuinely love infrastructure-oriented strategies, partially due to their risk-adjusted return potential, what we've seen over time and what we think will occur going forward, because there's a tremendous amount of investment that needs to occur in multiple economies in infrastructure. That very low correlation that we've seen to markets overall. And we think clients are seeking those kinds of different types of investments that kind of zig when others zag. And to us, infrastructure very much so fits into that. We think that gold is another area to turn to for clients that want a degree of a diversifier in portfolios. You know, the yellow metal, so to speak, has been accumulated to a greater degree by by central banks most recently. And if you want a bit of a hedge against profligate spending by governments, rises in debt to GDP ratios, long-term debt that's a bit of a concern, we think that gold that you can also own in physical form for a small portion of portfolios is a good place to turn.
Nice to see you, Eric. Thanks for stopping by to see us.
Thanks for having me.
Okay. Eric White-Ennis, EMEA Head of Investment Strategy, joining us from JP Morgan Private Bank. We're going to talk about some of the stocks we're going to be watching this morning. Siemens out with numbers a little bit earlier on. Look, the company's saying that its guidance is going to be at sort of the low end of the range that it suggested. Actually, I think that's probably a little bit better than actually the market was anticipated. The stock is called higher this morning. We'll talk about that and all the other stocks we're going to be watching. That's next. This is Bloomberg.
So Nikkei and S&P 500, reasonable, notwithstanding the hedge funds and the volatility got what they wanted, and by no means is it behind us, but the severity and the degree of it we believe is behind us.
We're still in the soft landing camp. Our point is, look, markets got spooked by the payroll last week. They got spooked by the ISM manufacturing data, but the economy is not that bad.
The market sentiment swinging to a recession with the SAM rule, etc., getting triggered. I'm still not in that camp because I think there are enough resilient factors in the US economy.
Even if we have a downturn, it's going to be a fairly shallow downturn.
So it's sort of a mixed bag, because I think the policy reaction function does differ across Asia, and not everyone is just following the Fed.
Some recent Bloomberg TV guests with some fairly relaxed views about the recent bout of volatility we've seen in markets and for risk assets. Joining us now, our Markets Live executive editor, Mark Cudmore, with his thoughts in 3 minutes on the markets. Mark, good morning again. Let's start with that volatility. We just heard some fairly relaxed views from guests there about volatility and how far through it we are. You fear, though, that this could be a bit of a theme? I mean, it can be in August.
I share the relaxed view overall. I do think elevated volatility is a theme for August. Seasonally, it tends to be higher volatility. Partially it's just because it's holidays in most of the northern hemisphere. And it's just, it's when there's sporting events, people are off, people kind of, just park on the trades and leave them alone till September. Now that they've been stopped out, they're going to be less inclined to get excited about opportunities in August. And they're going to wait a few weeks. So I do think we're going to see higher volatility. I agree with one of the guests there that one of those quotes, I don't expect the volatility to reach the extremes of Monday. So I think it's going to be a higher level of volatility than we've had most of this year, but that doesn't necessarily mean as high as we've had over the last week. I overall share the kind of view that I'm not expecting a sudden hard landing in the US, and I think that the downturn that we can expect to see over the coming weeks does provide opportunities for potentially stocks or assets to do better into year end. But I do expect more losses in the weeks ahead. Not necessarily dramatically so like Monday, but some sort of negative trading over the next coming weeks.
Mark, morning. Why did the 10-year auction in the States go so badly yesterday, and will the 30-year today follow suit?
It's a good question. I think the 30-year probably won't do as badly, but it probably will do, not great. I think what happened is that yields just rallied way too far too fast. And the only way you can justify the level of rate cuts priced in the US, not just the US, actually most of the way around the world, but particularly in the US, is if the US is suddenly going into a hard landing. And if it's suddenly going into a hard landing, suddenly going into a recession, well, people get a bit worried about what they're going to do on the fiscal side as well. So it's not particularly great for the long end, even if long end yields come lower initially. So I think that the bias for yields over the coming weeks is to go higher amid volatility, two-way volatility, but overall to go higher from here unless we have a really shock either in markets or the economy. And I think that's the backdrop for why the auction did badly. And as I said, we're also going into election later this year, which is going to encourage bear steepening of the curve because both parties don't care about the fiscal side.
Are we done with selling Japanese stocks, Mark? We saw a big drop from July highs, of course. We've kind of reclaimed around a third of that. What's your expectation?
We're not done with selling Japanese stocks. I think they're going to underperform from here. I think the story is over. It's been broken by a central bank misstep. The BOJ has killed animal spirits just when they're going to escape decades of stagnation. The economy is pretty stagnant this year. It's barely growing. It's one of the slowest growing economies in the world. And now you've got a central bank that normally disappoints and confuses. Well, last week they did not disappoint. I can't claim that this time around, but they're still confusing. And that does not encourage investment in an economy that desperately needs encouragement because there lacks animal spirits and there's a lack of natural growth, and therefore Japanese stocks will remain underperformers.
Thanks, Mark. Thanks for your thoughts. Bloomberg Markets Live Executive Editor Mark Cudmore. You can find the thoughts of the whole Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. Let's get stocks to watch this morning. Joe Easton from our equities team has a briefing. Joe, good morning.
Morning, Anna. So Siemens over in Germany today saying that their revenue may actually be at the lower end of their guidance. That's partly due to them having too much inventory on their books, as the CEO explained to Bloomberg earlier today.
Over the last 3 years, the automation business was growing tremendously fast. And this ended up in quite a bit of stocking in our distribution channels. And this stocking effect has to go down. You have to destock on the one side and the market has to pick up on the other. This is the unpredictability. How fast does that go? When will the market pick up? We see a certain light in chemical industry, also in China.
So that's the negative line out of Siemens today. But as Guy mentioned earlier, we are actually seeing some small gains in this stock on the Tradegate exchange. They have upgraded some of their software outlook. And also, bear in mind, they did do a big profit warning a few months back, potentially lowering expectations into these results. We've also seen weakness from the likes of ABB. So we might potentially see this stock extending those gains up around 40% over the past couple of years for Siemens. Then staying in Germany, we're also looking at Rheinmetall. Now, this is one of the best performing stocks we've got on the European market, and they are reporting a jump in some of their defence earnings. The company seeing operating profit up 90% over the half year, sales up 30% as well, and they have an order backlog of around 60 billion euros following massive orders for artillery from both Germany and Ukraine. This stock even outperforming some of the big gainers on the European market since the war broke out in Ukraine, and also the other geopolitical issues in the Middle East, beating even the likes of Rolls-Royce, as we could see on the screen there. But analysts still love this stock. 16 buys, not a single stock. We'll wait to see if it can extend those gains, but potentially has already rallied a lot, so we might see a little bit of easing in that one. Finally, in the UK home builder space, we've got an update on one of the big M&A deals. Barratt's plan to buy Redrow. Now, the CMA today, the UK regulator, raising concern around a specific local area called Whitchurch in Shropshire. So they get a shout out today. Now, the CMA is saying potentially it could lead to higher pricing in the Whitchurch, and therefore they want the company to address this. But the bigger picture is there are no national concerns around this deal, according to the CMA. So if Redrow and Barrick can address these issues, we might potentially see that deal get over the line. Now, there are other M&A deals going on in the space. Crest Nicholson has a takeover bid. Persimmon also trying to buy a privately held company as well. This is the latest one, potentially may head to approval if those concerns can be appeased. Keep an eye on those stocks later today.
Great stuff, Joe. Thank you very much indeed. Joe Easton running us through all of the equity news that we have been presented with this morning. Broadly, looks like European equities are going to maybe open a little bit low, which is interesting, actually, because the bulk of the corporate news we've seen this morning has been fairly positive. Siemens looks like it's going to open higher. Beazley looks like it's going to be opening higher. Entain looks like it's going to be opening higher. Zurich Insurance looks a bit of a kind of coin toss as to what it's going to do at the get-go. But broadly, the corporate news actually fairly solid this morning.
So that's the corporate news flow and the contribution it makes to Thursday's trading session. A lot of this has to do with what we saw in the States yesterday, though, doesn't it? Because we were down by 0.8% on the S&P by the close, having given up a 2% gain. European equity markets closed 2% up, whilst the US was feeling pretty buoyant. So there's that sort of overall vulnerability,
arbitrage,
yes, regardless of what was reported on the ground. Yeah, we'll continue to watch how these individual names stand up in the face, then, of that macro theme.
The futures look a little bit like this. Let me just show you them before we get into the opening run. We are broadly positive. Sorry, we were broadly positive yesterday. We are a little negative this morning, as Anna says. It's kind of pricing in that arbitrage story with the US close yesterday. Anyway, we'll run you through the run-up in just a moment. This is Bloomberg. Thursday the 8th, good morning. We're a couple of minutes away from the opening trade here in Europe. Yesterday, a really solid session for Europe. We called yesterday Whipsaw Wednesday. We haven't really, to be honest, come up with a good name yet for Thursday. Maybe we will by the end of the show. But certainly what we saw yesterday in Europe was a really strong rally up into the close. US kicks in. It's all looking fairly good. And then the US turns around and falls quite sharply. Bunch of factors behind that. One of those, certainly the weak US 10-year auction that we saw yesterday. Anyway, the US finished near session lows. We have to price that in this morning, and that is largely why we're seeing futures doing what they're doing, i.e. this. A bit negative. We're down by around 0.5% on the 50. The FTSE's down by around 0.3%. US futures have actually turned around a little bit, but not by much. And I think that's kind of where we are going into today. Bunch of corporate earnings that we need to factor into the mix as well, which largely this morning have been broadly positive, and I'll talk about those in just a moment. But I think we are building up to the claims data out of the United States, that weekly set of data, which will give us an idea of what is happening with the labour market. But the corporate news so far, Anna, this morning, actually fairly favourable.
Yeah, let's have a quick look at some of those stocks that Joe was running us through, some of them that are in focus this Thursday morning. Siemens is one of those. We are seeing some calls that this one will be higher at the start of trade. There had been some disappointment for some, perhaps, in what they're saying about where they will fit, where their revenue estimates will come down. But maybe the street was already more pessimistic than the guidance. So net, that might be a positive. Zurich Insurance also in focus. They don't see, Mario Greco does not see a recession in the US. We talked to him about that earlier. Profits up, better than estimates, revenue higher as a result of the life business. Rheinmetall also in focus. Margins better than estimates for reasons we understand. Guy, the open then, just seconds away.
It is the opening trade almost upon us. What kind of a Thursday are we going to have? Let's find out. We're anticipating that we are going to see a negative start, and that is pretty much what we are getting. As you can see, we're already out of the gate on the FTSE 100, not down by much, but red on the screen already. We need some sort of alliteration that goes with the T that we'll work out as we work our way through this. It doesn't look like a tumble, certainly at this point. It looks like a fairly mild move to the downside as we price in some of the corporate news that we've been getting. We'll get to the details of that in just a moment, and that kind of arbitrage story with the United States from yesterday, that sell-off that we saw into the close. So here we are. FTSE's down by, well, actually, 0.75%. That's maybe a little chunkier move to the downside that we were anticipating. Well, certainly when I got in first thing this morning. But the FTSE MIB's down by 1%. The IBEX is down by a similar sort of amount as well. Stock 600 opening down by around 0.5%. We'll get a price on the DAX very shortly. The other factor in the mix this morning, Anna, is we've got a lot of ex-dividend stocks in the market as well. So that's a factor that is going to certainly weigh maybe on the downside as well.
Absolutely. The team has provided us with an exhaustive list of all the ex-dividends. I will save everybody and I won't read through all of them, but just to point out the likes of AstraZeneca, BP, just a couple of them that catch my eye, NatWest, Pearson, there's some really big names in here, Unilever, Standard Chartered, so some big names, and that will have an impact. In terms of those sectors then, that said, around ex-dividends, most sectors are in negative territory, Guy, and that goes along with the extent of the losses that we're seeing across European equity markets this morning. So we're down by 0.5% now on the Stoxx 600. Basic Resources is the worst performing, down by 1.3%. And this is nice for us because it takes us back to one of the conversations we were having right at the top of the last hour around base metals and around weakness there, around recent weakness in copper prices. So Anglo American, Glencore, both of those a little weaker. Concern around the US growth story, concern around the Chinese growth story as well. So that's the basic resource space. Banks also weaker, technology also a little bit weaker. So some of those some high beta sectors losing a little bit of ground this morning.
Understandably. I think we'll maybe give it half an hour or so to settle this market down, get through some of the kind of the pricing around the States, figure out exactly how we're going to deal with some of these corporate news elements that we need to factor in as well this morning. So kind of single stocks, we've kind of worked our way through some of those. We've given you an idea of what is happening with the sector story this morning. We've priced in the United States. Where do we go from here? Eleanor Lee, fund manager at Polar Capital, joins us now, where she manages the Melchior European. How do you say that?
Melchior.
Melchior.
Right.
That's been my morning. Believe you me, I've been almost right all morning, but not quite. How's the week gone for you? Where are we in this process? We've seen, obviously, a big volatility spike at the beginning of the week. We're kind of unwinding that a little bit. But are we going back to a low volatility environment? Are we going back to an easier operating environment that we've seen this week? Or are we in a different paradigm, do you think?
I wish I could say we were going back to an easy environment, but I don't think that's the case. I expect the environment to still be quite volatile, but perhaps not the levels that we saw on Monday. I mean, Monday, there were signals of panic. The VIX went above 50.
Yep.
Last time we saw that was in the pandemic. And there was a lot of volatility in stocks, which created opportunities. So I don't expect us to go back to that level of volatility, but I still think there's a bumpy road from here. Clearly, the market is trying to force the Fed's hand. The labour market's been weakening, and the market wants the Fed to cut rates.
Right to the rescue.
Yes, exactly.
The danger with that is that if the Fed does rise to the rescue, that it may be perceived as showing that there are signs of weakness in the economy that's just bad for risk assets. So is the market kind of caught between the devil and the deep blue sea here?
Well, I mean, the labour market is slowing, so the good news is that the Fed actually has the toolbox to respond to that. I think, if the Fed came out and gave an emergency rate cut, that would be a sign of panic. And that is not my base case. But I think the market would be reassured by the Fed taking into account the recent data that we've seen, the slowing in the economy. It's not been uniformly negative data, as we saw with the US ISM this week, but clearly there is a slowing and there needs to be a response to that. So the good news is that they have the toolbox to do that. They have room to manoeuvre, and I expect them to do so.
Eleanor, good morning. Does it feel, though, talking a lot about feelings and emotions in the markets this morning, does it feel like a market that needs 50 or an economy that needs a 50 basis point cut, or would 25 suffice? Given the weakness, yes, you're talking about the weakness we've seen in the data, but given the extent of that weakness, does 50 seem overdone?
Well, I think there is a view that if the Fed had the labour data, a week earlier, that they would have cut in July. So by doing 50 in September would be more catching up with that. So going from being behind the curve to potentially, getting on the right side of this. So I think the market will be looking for 50. 25 would be seen as disappointing. Having said that, though, they will be looking at the complete picture. So in terms of the labour market, we know that some of that data can be prone to revisions. There's been talk about if there were some one-offs, weather-related. So I think they'll be looking at the complete data set, as they should before they make a decision.
Thinking about the volatility we saw at the start of the week, and you said that there might be more of that to come. I mean, JP Morgan saying we're about 3/4 of the way through unwinding the yen carry trade, which is quite a big an achievement. It's been a bumpy ride, and some things have got broken along the way. What else are you looking for to give you a steer as to whether we're through this bout of volatility?
Well, the yen carry trade unwind was obviously one of the unwinds we've seen, but there's also been just broader unwind of a very crowded positioning since mid-July, since earnings season began. So I think we're looking for valuations of some of those crowded trades to come back to more realistic levels, and some positioning in that to unwind. But it's already gone quite some way, having been happening since the middle of July.
And so that's where we are at the moment. I'm just looking at US futures sort of weakening a little bit as we speak, and the European equity market picture looks weak. We thought that was just catch up with yesterday, but now if US futures are weakening, we're sort of flat now, having priced in earlier some moves to the upside. What do you think? So we've talked about some of the things in the driving seat, the carry trade and the unwind around other positioning. What do you think the earnings season is telling us about where these markets go next, or is it just not really about the earnings story at this point?
No, I mean, I think it's very much about the earnings season, but it's also more about the outlook. So in Europe, earnings season has actually been slightly better than expected, but that hasn't really mattered if you look at what's happened to stocks. There's been a very negative skew to earnings, so the price reaction, as you've seen, has been quite violent in some reports, and I think that's because the outlook has softened, and that's really what's mattered the most. On the back of earnings, we've had a more muted outlook, negative revisions. So it's not really been about the earnings themselves, but that outlook which has softened.
So what do I do? It gets to the end of this week. Been a huge amount of volatility. We've calmed down a little bit. Do I get back to being risk on? Do I go back to buying stocks? Do I go back to buying tech stocks? What do I do at the end of this? And is that in any way different to what I did before?
I think you have to. Our base case is that there will not be a recession, but clearly the risk of policy error and misstep has increased.
Right. So that's less risk. So I take less risk in that kind of environment?
I think you have a balanced portfolio. So in terms of extreme moves like we saw on Monday, there was clearly an opportunity there to pick up some stocks, some very high quality stocks. I'll take, for example, ASML at one point on Monday was down 30% over the last 3 weeks on an intraday move. It was below its long-term average multiple. So moves like that are extreme, and that creates an opportunity. So I think you have your shopping list of high conviction stocks that you want to add to on periods of volatility, but also be cognizant that the data is slowing. Having a bit more defensive exposure is also attractive.
A balanced portfolio has underperformed recently. Is it going to outperform in this period of higher volatility? If I haven't been in the top 10 tech names for the last year, my portfolio has done worse than the market.
Yeah.
Is the new environment better for a balanced portfolio?
Well, I think if we move into a coordinated rate cutting cycle in the second half, that could help to have more breadth in the market.
Right.
That's been part of the problem, is that there's been an extended period of concentration in the market over the last 18 months. But rate cut cycles can actually be a prelude to having some broadening in the market.
So if we're going into rate cutting and we are alert to weakness in the global economy, I'm looking at basic resource stocks down the most today, worrying about China, worrying about maybe the possibility of a US recession as well. Overlay on that some of the sort of longer term themes that investors are thinking about, and I think here about AI and the opportunities there. How resilient can AI themes be if we see that cyclical downturn? Do you think this is something that persists through the cycle, or no, very vulnerable?
Well, I think we're positive on AI, and we think it's a disruptive technology. I think there's been a healthy dose of realism in some of the pullback and in some of the questions that are being asked about the CapEx spend, but we're still at the very early innings of what is a long-term structural trend. So I'd still expect those stocks to do well, and that AI enablers should have a place within your portfolio. The use cases for AI are, we're still at the early days. There'll be more products launched in the second half. And, we should get more confidence about that AI story being monetized as time goes on. But it's still very early, and I think, the market is punishing some stocks, expecting that killer app to already be, realized. But, if you think about it, ChatGPT was launched less than 2 years ago. I think the expectations of the killer app already being in place are a bit too...
Yes, because it feels like, unless you're NVIDIA or one of the other fortunate and well-placed chip makers, it's not been a revenue driver yet. It's been a big cost line. But so when do we pivot to this becoming more than just this sort of cost and a concern about CapEx into something that really delivers? What kind of timescales are we talking about?
Well, you've seen in the US, some companies like ServiceNow upgraded guidance because of better traction from their AI products. But I think there will be a broadening of that trend, as I said, with more products being launched in the second half, but in a 12-month plus time frame. And companies are now realizing that, I think Capgemini CEO said it best, that AI is not a silver bullet. Now they're actually working on use cases, being more disciplined about where they can, drive revenue and cost savings from AI.
Am I more focused on the States still, or am I happy to invest in Europe? If we're going to see a more diversified story, does that bring Europe back into play?
I think Europe, the starting point is extremely attractive. Relative valuation discount to the US, even if you exclude the big tech stocks, it's on an almost 30% discount to the US, so it's an attractive point. The rates cutting cycle has already begun in Europe, so it's ahead of the US, potentially ahead of the curve. And it is very sensitive to rate cut cycles. So both from the consumer and corporates are very sensitive to rate cut cycles, so should tend to do well in a rate cutting environment.
Lovely to see you this morning.
Yeah.
You're thanking.
Thank you very much. Eleanor Lee, thank you. The fund manager at Polar Capital. Now time for Guy's Core 6.
My turn. Okay. Let's look at the Core 6, see what's happening. These are some of the big stock stories around Europe that we continue to watch on a daily basis. We'll get to the movers of the day in just a moment with Joe. But as you can see, there's a lot of red on the screen this morning. Novo Nordisk, one of the few stocks to be posting gains. But as you can see, LVMH, Ferrari, ASML, Schneider, Nestle, all in negative territory this morning. So the big heavyweights in Europe seeing a little bit of weight to the downside this morning. What else are we watching? Joe, you got the details.
So one of those heavyweights declining, Guy, is Siemens. Now, this stock was bouncing around pre-market on the Tradegate exchange. They are warning of too much inventory on their automated warehouse business. They have upgraded some other businesses, including the software unit, looking pretty strong. But it does look like the automation business weighing on that, down 1% at the moment. In terms of Rheinmetall, it's already up around 400% over the past few years. So we're not seeing much movement, actually just ticking lower now. Strong earnings once again, though. Deutsche Telekom and Allianz, the other two big German stocks among many today. Deutsche Telekom, of course, owns a big chunk of T-Mobile in the US, and that is doing pretty well at the moment. Allianz, PIMCO, strong. A bit of softness in some of their insurance business, but overall a pretty strong report from them. And there's a bunch of other insurance stocks with reports out today. Zurich, the surprising weak one. Now, there are some analyst notes around some certain capital issues at the company in terms of their report today. But the earnings, again, overall, the life insurance business, as Anna was discussing earlier, does look pretty strong. But that is a surprising underperformer today. Munich Re out with numbers as well. And the Lloyd's of London insurers, Beazley. Now, there was concern that this company has heavy exposure to the recent software outage, the outage that disrupted My Holiday, but Beazley gaining 10%, reporting better than expected numbers, surprisingly for that firm, maintaining their outlook, and Lancashire is the peer on that stock as well. They've also got numbers out. Both of those Lloyd's of London firms moving higher this morning. In terms of some other earnings stragglers to bring you, Nordic Semi, the semiconductor firm, they have actually had a series of profit warnings, but today in-line guidance, giving that one a bit of a relief. Deliveroo and Entain is takeaway food and gambling, to our favourite sectors. Now, both of these boosted by the Euros. Of course, us England fans do want to forget about that as quickly as possible. But Deliveroo actually doing a £150 million buyback, something you wouldn't expect to see from a company that has been unprofitable for a long time. And Entain, a massive boost in their earnings from the Euros. A lot of England fans losing their bets. That's good for the bookies. And Sandoz, finally, over in the pharmaceutical space, the generics business spun out of Sanofi. Spun out of Novartis a couple of years ago, getting my pharmaceutical companies mixed up. But they have actually reported some weakness in some of their pricing today. So that one is declining at the moment. A quick check on the home builders. Redrow's takeover by Barratt potentially might get approved if they can fix those local concerns from the CMA, but actually a bit of weakness in those markets today. And Persimmon also had numbers upgrading its guidance. Potentially the Bank of England rate cuts will help that stock as well once those come through into the mortgage market. Finally, a couple of morning calls to bring us away from the earnings and M&A. Now, Glencore actually reinstated buy at City. That's after their coal business was not going to be spun off, according to the update yesterday. City actually think that's quite a good business, given the exposure to the steel sector. And finally, one more to bring you is BP downgraded at HSBC. This is the second downgrade for BP in 2 days. We yesterday had RBC. The buyback issues are easing. One thing to note, though, there are some ex-dividends on these stocks, as Anna was mentioned earlier, but that stock is 1.8% lower in London today.
Joe, thank you very much. Joe Easton from our equities team. Joe was telling us about the house builder M&A earlier, Guy, and the intentions there and the CMA objections. I do think if the most that the CMA could find to object to is one area of 10,000 people and a lack of competition as a result of this deal in that space, then, you know, you think there'll be remedies that maybe the business can present. And the business sounds confident it can present those. And
there's going to be a huge amount of pressure to build houses.
Yes.
And that is going to represent some huge challenges. Is a consolidated sector better at delivering on the targets that the government is going to set? That is an interesting question. Is it better at investing in the kind of technology which is going to deal with some of the labour shortages that we're going to be seeing? That, I think, is an open question. So I think there's a kind of bigger picture story here, which is going to be really interesting to kind of roll into how the CMA thinks about it.
Yeah, and sticking with the UK, he flagged Entain as well, just worth mentioning that the Entain move up 8% or so, just shy of, and Flutter being lifted on the back of that. That's the only sector, travel and leisure, and it's very much that leisure bit that is lifting markets or providing the only upside to markets, I should say, in what is otherwise a pretty down day. Coming up, another stock that is moving to the downside. Siemens sees demand for software and electrification products despite weak factory automation sales hitting returns. We'll bring you Guy's interview with the CEO. We'll get into some of the really interesting detail here because the market responding negatively in the near term, but actually pulling back from those losses, now just down by 0.2% as the market has a lot to read through when it comes to these Siemens earnings this morning. This is Bloomberg.
We are quite happy with that quarter. It was driven basically by another very strong quarter of smart infrastructure. Our electrical business grew by 21%, but we also had a very strong software business. The underlying the software business was very strong, but we also had a couple of wins, large wins. They don't repeat in that size again, but this helped quite a bit also in drive our top line and bottom line as well.
Donald Bush, the CEO of Siemens, speaking a little earlier to me this morning after the numbers dropped. And the market can't make up its mind on this one.
No, really can't.
So we've been all over. Pre-market, we were up.
Yeah.
We opened down. We've come basically back to flat. It's a real kind of... the reason it's difficult to read is that automation is clearly a problem. They've talked about the fact that they're basically, as a result, their guidance, which is on the revenue line, is 4 to 8%. They're probably going to be at the low end of that. But the market kind of had already...
Yeah, the market was at 3.5 anyway, wasn't it? So that was the thing that stuck in my mind,
So this is better. So automation is clearly still a problem, and there's a whole kind of destocking process. And so industry basically needs to come back and start buying more stuff for that process to work. But on the other side of things, the software business is doing quite well. You've got other areas of the business that are performing quite strongly, and the margins there look fairly strong. He's not overly concerned about a recession either, which I think is interesting too. So broadly, actually, I think it's a fairly well-balanced business, and that, I think, is why the market is struggling to kind of get a sense of direction here.
And you do get a sense that even as things are worsening a little bit at the margin for European sentiment this morning, we're now down by nearly 1% on the Stoxx 600, in fact. As that's happening, the Siemens share price is actually on the rise, so we're pretty flat on Siemens now, coming back from earlier losses of more than 1%. So that's where we are on Siemens. Another share price that is outperforming a little this morning, up by 0.6 of 1%, is the Rheinmetall share price. This is the defence business, reporting weapon and ammunition sales for the first half of the year that beat estimates, margins coming in higher than anticipated. We understand very well, sadly, where a lot of the demand for these products is coming from, but there's a lot to talk about here when it comes to this sector. Let's bring into the conversation Bloomberg's Laura Alves, who's in Frankfurt for us. Laura, good morning. So how did Rheinmetall fare then in the second quarter, and does it tell us a broader story about the defence industry in Europe?
Yeah, so the second quarter for Rheinmetall has once again been a really exceptional quarter. The CEO has referred to what's happening to the company at the moment as an accelerating super cycle. So he says that he's never seen that kind of growth before. The company has doubled their profit. They have increased sales by half. So you can really tell that this defense ramp up in Europe is very much still ongoing and that there is a lot happening in that space. The company is targeting around 10 billion euros in sales this year, which is also unheard of for a German defense contractor up until this moment. And in addition to that, with Rheinmetall, all eyes are on backlog as well, which is, of course, a big discussion in the defense space as a whole. Their current backlog is at over 48 billion euros, and this is probably going to swell to around 60 to 70 billion euros by the end of this year. So you can really tell that there is no shortage in orders and no shortage in interest in Rheinmetall's products.
The CEO was recently at the centre of an assassination plot. What does that tell us about how critical this company, this sector is in terms of the war in Ukraine and Europe's efforts to defend itself? The fact that there was a plot against him specifically speaks maybe to sort of just how critical these companies are. Any misstep, even marginal, could cause problems.
Yes, absolutely. Like, the plot was against him specifically, but it was also against defense chiefs more broadly. The plot against him was the one that was the most mature. It was foiled by US and German intelligence services. It was a Russian plot. And what this really tells us is that this is another facet, and that defense companies are really being pulled into another facet of this hybrid war that Russia is waging at the moment, with, for example, cyber attacks, espionage, and so forth. And these assassination plots against defense chiefs are really another part of that. And of course, with regards to Rheinmetall specifically, the situation is currently being closely monitored at all times. Papberger is receiving special protection at the moment, but of course, the situation remains very tense.
And what is Rheinmetall's role in Ukraine at this point then? What do we know about that, Laura?
Okay, so what's happening there is that they're really intensifying cooperation with Ukraine, and they're also trying to set up more operations within the country itself. That includes a tank repair hub that was launched in June in cooperation with a Ukrainian defense contractor as a joint venture. And the CEO also announced that they will be producing the Lynx combat vehicle within Ukraine itself. And secondly, of course, another major focus point for Rheinmetall is ammunition. And they are setting up an ammunition plant within Ukraine as well. They just received their first order for technical equipment for this ammunition plant, and output is supposed to start in the next 24 months. So there is really a lot going on within Ukraine itself in conjunction with Rheinmetall as well.
Laura, thank you very much. Laura Alves there with the latest on the defence sector. Coming up, we'll get back to market dynamics and specifically around corporate debt. Corporate debt issuance rebounding in the middle of this week after it was sort of frozen at the start of this week. We'll get the thoughts of Omotunde Lawal from Barings, who'll be joining us shortly. We saw that 17 companies in the US raised a lot of money in terms of the primary issuance market and almost having a negative impact on what was going on in Treasury auctions as well. So that is where we find ourselves in a rather strange week for corporate debt. We'll put all of that in context. We'll talk about risk and how these markets are absorbing risk right now. This is Bloomberg. Welcome back. This is the opening trade. 30 minutes into Tuesday. No, let's not go back there. Thursday's session. We are down by just over 1% on the Stoxx 600. The FTSE kind of on par with that, really. The CAC 40 is also weaker. They're all down by around 1% or so. US futures have worsened a little bit after an attempt to go higher a couple of hours ago. Let's talk about what's going on in corporate markets, though, corporate debt markets. Volatility at the start of the week had a chilling effect on global primary corporate debt issuance, but it didn't last long. Yesterday, 17 blue-chip companies offered nearly $32 billion of debt, the highest US investment-grade issuance that we've seen on any day this year. What's happening in these markets? I'm pleased to say we're joined by Tunde Lawal, head of EMEA corporate credit and emerging markets corporate debt at Barings. Tunde, nice to have you with us once again in studio, and we like to we'll turn to you to understand exactly what's happening in this corporate debt market, because it does seem to have been a week of huge volatility in some assets, and to some degree that filtered through, certainly in terms of that primary issuance story. Talk to us about what we've learned this week from this market action.
Right. So we woke up on Monday morning thinking, oh, Black Monday. And it really was just, you couldn't do anything. You were just transfixed, because you could see bond prices being quoted down, you could see spreads being quoted lower, commodities were lower. And as the day went on, I'd say probably lower beta stuff was maybe 5 to 10 wider on Monday, and the higher beta stuff, the more high-yielding stuff, was quoted anywhere from a point down to 4 points down, depending on where you were. And all new deals stood down, so all primary deals stood down, as you would expect. But I think as the narrative sort of started to come through in the day, where people are ascribing some of the weak non-farm payroll data to weather issues, as well as some disruptions, and actually cautioning everyone that back in April, we did have a jobs number that got revised down materially, and then in May, we had a doubles, and we didn't panic. You know, we had a doubling of payrolls. We didn't panic. So why are we panicking on one number and calling for emergency meeting? And so some sort of normality started to return into the market on Tuesday. We saw that sort of correction back on Tuesday. We started to see things maybe snap back 30-40% of the way back. And then yesterday there was a bit more of a recovery, although less so than Tuesday, where we saw the recovery. And yesterday, as you said, was the biggest year-to-date supply day in the US IG market. On the EM side, there's only one deal that's priced so far this week, which was China Aluminium.
So it's been a big week. There's been a lot happening.
There's been a lot.
What does it tell us that we got that big issuance yesterday from all those US corporates? Was it just because nothing happened on Monday and Tuesday, and so it came through? I mean, it seems to be a sign of risk appetite returning a little bit after what happened on Monday.
Well, yes, because if you look also at what the commodity prices were telling us, actually we don't think we're headed for a hard recession in the US. And so everyone's sort of getting back to, well, I want to de-risk. If I've got funding needs, I want to de-risk ahead of US elections. And we're coming back to the whole, well, the world's going on. Yes, it's slowing a little bit, but it's going on. And even corporate earnings, we're in full swing of corporate earnings season as well. None of the corporate earnings that are coming through is telling us we're headed for a hard landing in the US or a recession. So corporates are just getting on with business as usual.
Let's park the triple Cs for a moment. Do we go back to the same spreads that we had before Monday? Is this a reset? Has something changed? Do we just go back to this huge demand, this almost insatiable demand, it felt like, that we've had for credit?
Right. So prior to Monday, corporate spreads were, in most asset classes, at almost all-time tights, if not all-time tights. Everyone's talking about how spreads are really tight. But it was less about the spreads. It was about the all-in yields as well, right? And this was the same messaging we had for clients was, yes, spreads. So if I quote the JP Morgan Corporate Index, the SEMBI Index, for example, spreads were at sort of record tights for decades where we were. We were at 200-ish, very, very low 200s. But it was less about that. Now we're sort of back around the sort of 240 level. On the IG side, we're around the 140. On the high yield side, we're about the 440. Do I see us going inside of 200 on SEMBI? Probably not. Because again, when I look at where spreads are versus how much tighter they could grind, I think there's probably not that much room, because a lot of credits are priced to perfection where we are now, and none of it is really factoring in what sort of volatility we might get to second half of the year. And so I think returns will largely be driven by what we get in the risk-free rate for the second half, and probably spreads don't go inside of where we were before. So I think we'll recover some of it, but probably not going inside of where we were before.
Okay, let's talk about the second half. If I listen to a lot of the bank calls, the sense seemed to be that actually there's been a bit of pull forward on issuance, primary.
Correct, yes.
Does that mean, how much lighter does the second half look?
So on the EM side, for example, I think the call for full year gross supply is somewhere around the 440, 450 billion. I think we're punching close to 300 here now at the moment. Yeah. And so really a lot of that has sort of printed in the first half. So second half,
most of it, yeah.
Exactly. So second half, even though we may or may not get Fed rate cuts, I think corporates are thinking, well, if I've got a window now, I must come to the market now and sort of lock in these rates that I can get, where you've got windows of stability in the risk-free rate. And I think investors like us on the other side are thinking, well, I want to lock in these higher coupons here and now. So there's a bit of a sort of marriage of convenience going on in the first half. Second half, where we don't know what's going to happen with geopolitics. We don't know what's going to happen with US elections. And we really don't know if we might get a resurgence of inflation in second half, which some people are calling for as well. So there's all sorts of unknowns for second half that if you have a window in first half, you should take it. And people are taking it.
Yep.
All the more reason, then, to quote this nice acronym which you introduced me to in your notes, Tunde, today. I'd never heard this one. I've heard of FOMO, but I've never heard of Omijom, which 1 month is just one month. I mean, so taking us back to the sort of underlying story in the United States, as we wait for all of that geopolitical uncertainty to play out, we're back to thinking about the Fed and back to thinking about the underlying performance of the US economy and whether we do get a soft landing still or whether a hard landing could lie ahead. We get claims data later on today.
It's a big day for claims data.
Right. Is it going to be a big day? Is this a day where we could be spooked in the way we were on Friday?
Well, I think everyone's looking for the next data point to sort of hang their hat on. And what we've been saying is you shouldn't look at just one data point and freak out on one data point.
You look at two and then freak out.
Well, let's hope we don't freak out today.
Let's hope.
But yes, certainly I think there'll be a lot more scrutiny and a lot more interest around today's initial jobless claims. And then next week, we've got obviously CPI and retail sales data, which again gives us a better sense of what's going on underlying whether the Fed really, truly does have a reason to do something.
OK, let's talk about the Fed. What signal would you take? What signal do you think the market would take if the Fed delivers a 50 basis point cut? Is that we're just playing catch up, we probably should have cut in July, we didn't, we're delivering kind of two together? Or does the market go, something's going on here, I need to be worried about this, the Fed's cutting 50 basis points, I need to be worried?
I'd be in the latter camp of if they do a 50, then that tells me they're seeing more than we're seeing and they're worried about something coming
The 50's a hard landing?
50 for me is something's not quite right.
Yeah. 25's a soft landing? So
25's a business as usual. We kind of telegraphed we may or may not do 25. If inflation plays ball and all the prints are showing a softer landing and all of these sort of gradual slowdown, 25 is to be expected.
So big rate cuts don't signal risk on necessarily?
No. Because, again, it's really about what's driving that.
You mentioned commodities a few times in our conversation and what commodity prices are doing at the beginning of the week. And I mean, maybe that's because some of the issuance is coming from that space. But I wonder what clues you're getting from that market, because geopolitics perhaps supporting prices to some degree. Certainly if you look at oil, that seems to be some of the chatter there. But then we've got base metals actually having a pretty tough time, in danger of, I think, on one of the LME indexes, of erasing all of this year's gains. I mean, what weakness does that signal?
So I think after Monday's move, I think you've sort of had commodities sort of recovering ground, oil prices, even copper, zinc as well. We've had some of the commodity companies releasing numbers in EM. Structurally, I think things like copper, iron ore, lithium, that are metals that are essential for the green transition. I think people structurally are quite constructive of them. I think we generally as a house are constructive on copper. Yes, we are getting some swings where people fret about China slowdown or not China slowdown, and that does give you some sort of tremors within copper prices. But I think structurally everyone's still sort of supportive copper prices, and I think for us we are constructive copper prices.
So where does this... OK, let's wrap this conversation up. We've had a massive week waiting for claims. We'll see what claims tell us a little bit later on. Are we in a new place at the end of this week than where we started this week? Are we going back to what we had before, or are we seeing something new and different that we need to adapt our portfolios to?
We all feel a little older, that's for sure.
Yeah, more grey hairs. No, I would be in the camp that no, because nothing in the corporate earnings that we're seeing coming through tells me we're headed for a hard landing just yet. Yes, there is a slowdown in pockets, and yes, we've been hearing about subprime segment weakness in the US for some time. We're hearing about, even some of the Mexican companies, when they report numbers, they tell us they're seeing some softness in their US markets on sort of basic stuff like confectionery and bakery goods and things like that. So there is some softness in some segments of the US market. But are we in a different place where...
So why did the market freak out?
Why did the market freak out on Monday?
Is it just the payroll number? Is it just we haven't had a correction for a while? Is it... I don't know. I'm still trying to put my finger on it.
I feel it's the payroll number. I think it was the magnitude of the miss on the payroll number that spooked everyone, and the fact that spreads were just already at quite tight levels. And everyone's freaking out thinking, maybe the Fed's made a policy mistake and maybe they haven't. But actually, you get a data point. If we get a data point next week that shows that actually inflation is firmer than was expected, then we're probably back to where we were, where we're thinking, well, maybe actually the Fed doesn't have any cuts this year.
Wow.
Maybe.
Okay. That would be quite a round trip.
What? Exactly.
Yeah, we've gone from emergency rate cuts to...
And you know, to just answer your other question is, why did the market freak out on Monday? Remember, it's August.
That's also
Most
true.
people are on vacation somewhere. So we're running a very light bench already, and you get that sort of big miss in payrolls. You get exacerbated moves, which I think is also partly to blame for what happened on Monday.
What are we doing here?
Well,
you should be on holiday. That's what you should be doing.
I'm glad you're here, because at least you can update us on what is happening.
We'd have no one to talk to if it weren't for you, Tunde, so thank you very much.
Tunde Lawal, Head of EMEA Corporate Credit and Emerging Market Corporate Debt at Barings. Thanks very much indeed. Not on holiday. Maybe soon. Anyway, after the recent global market meltdown, the Markets Today blog is currently holding a Q&A session with its in-house experts. If you want to get some answers to your questions, maybe I should be tuning into this as well. You can do so on your Bloomberg terminal. You can also do it on Bloomberg.com. What have we got coming up for you? We're going to switch focus. Anti-racism protesters have turned out in their thousands across the UK this week. Didn't see it last night, though. We're going to discuss if social media platforms can be held accountable for spreading misinformation. We're going to talk about that next. This is Bloomberg.
Welcome back to the opening trade. Sentiment seems to be slipping a little this morning. We're down just over 1% on the Stoxx 600, and it would be tempting to think that that is just catch up with the trade of yesterday in the United States, where we saw that big Whipsaw Wednesday event and markets closed weaker after initially being much stronger. Well, now you look at US futures and you wonder if that is the case or whether there's something more negative afoot, because E-mini's down 0.4%, as are NASDAQ futures. So sentiment, it seems, just ebbing a little bit as we go through the early hour of this European session. Switching focus away, though, from markets and to some of the politics that has been playing out here in the UK. Thousands of anti-racism protesters rallied across the UK last night following more than a week of rioting by far-right groups. This comes after UK Prime Minister Keir Starmer warned social media firms over online misinformation and toxic content that fueled the unrest. Let's get some analysis of the role that social media firms are playing here and the extent to which they are being regulated or not, with Palmy Olson from Bloomberg Opinion, who has been tracking this story. Palmy, good morning. How much has online misinformation then contributed here? Give us a run through of the role that it has been playing in the recent violence.
It's definitely played a significant role in the violence. Some analysis has traced some of the misinformation back to one news story on a site called Channel 3 Now, which after the Southport attack and named the alleged attacker as a Muslim asylum seeker. And that could have been the end of it. The problem was that story got screenshotted. It went viral on X, formerly known as Twitter. Influencers like Andrew Tate told his more than 9 million followers that the attacker was an illegal immigrant. And then Nigel Farage went on and cited that in TV interviews. So it really was just this kind of cycle of increasing the virality of this misinformation at a really tense time. And that just went on to cue these violent attacks on mosques and refugee housing. So it really could have just stayed as it was, just a little news story, but it was the virality of this misinformation spreading on X and also on other sites like Telegram, TikTok, which just became a big problem.
In theory, the UK's got new legislation coming into force, which originally conceived was designed to deal with some of these issues, but has largely been defanged, or certainly was defanged by the previous administration. If the new administration, the new Labour government, were to put some teeth back into this legislation, how should they do it? How could they do it?
Yeah, it's a great question. And, you know, I have to say the online safety law that was initially designed by the Conservative government was a very cleverly designed law to thread the needle of free speech. It took inspiration from health and safety law and said that tech companies have a duty of care to their end users. And essentially, it's not it gives Ofcom, the regulator here, the power not to go after content or even individual users, but to assess the systems and processes of tech companies and hold them to account, audit them, and make sure that in times like these, as we've just seen over the last 2 weeks, that they don't allow misinformation to spread. But as you say, the problem was just in the later stages of the law being passed, it was watered down. A very important part that made legal but harmful speech was removed. Legal but harmful material was removed, so that it only covers illegal content like calls to violence and hate speech. So all the online misinformation that we've seen, the stuff about this attacker being an asylum seeker or having this particular name, which was completely incorrect, that is all fine under the current law. So as far as what the Labour government can do now, I mean, the law is as it stands. So they're going to have to, if it's possible, to look at ways at addressing, what's in the legislation. Maybe that's something they can do. But I think what I understand from speaking to Ofcom, speaking to people who designed the act, is the best that the government can do right now is just engage with these companies, which is exactly what they're doing. They're having meetings. They're pushing them to really just be transparent about their misinformation policies and enforce them, because that's the problem. A lot of this misinformation goes against their own rules, even on X, but it's just not being enforced properly.
And Parmi, is part of the problem that, they're trying to engage with these social media platforms, but the boss of one of them is actually getting himself involved in this. I mean, to what degree do you think there will be attempts to limit what Elon Musk is doing? He's clearly with somebody with a lot of influence, and what he says goes a long way. But on the other hand, if he thinks to him a civil war looks likely, should he be able to say that? I mean, clearly we didn't see that happen last night. What do you think the government's intentions toward Musk will be?
I think it's a very tricky balance, because Elon Musk is essentially being an internet troll right now. He is just poking Keir Starmer, calling him two-tier Keir. He is making these very incendiary comments about the UK being on the brink of civil war, absolutely not helping, breaking his own rules of his platform. But on the other hand, the government has to be careful that it isn't drawn into this war of words with Elon Musk and essentially legitimize his authority in this whole situation. So I think it's a very tricky situation, because actually, if you look at Twitter's audience numbers and active users, that has been going down ever since Elon Musk took over. So yes, it is a very influential platform, but is it as influential as it was a number of years ago? Not as much. And so I think there's a very tricky balancing act that Keir Starmer has to make here, in terms of addressing what Musk is saying without giving him too much credibility and authority as an influencer. I mean, at the end of the day, Musk has 190 million followers, so something has to be done, but it's going to be very tricky in how they address it.
Parmi, we're going to leave it there. Thank you very much indeed. Thank you very much indeed for the piece. Useful insights into what is happening here as we watch it from multiple angles in the UK. Parmi Olsen joining us from Bloomberg Opinion. Busy day. Yes,
we've got jobless claims. Let's say that again, shall we? 1:30 p.m. UK time. US initial jobless claims. And the reason we mention it a few times today is because the market was so spooked on Friday by the payrolls number. This is also going to tell us something about the US labour market. And the last time we got this data, and it is weekly, of course, and so weekly data can be very volatile, but the last time we got this reading, it was the highest since 2021. If we get something that looks like that again, does that spook markets? Is the question.
To your point, it's weekly data. It's very choppy, therefore can be affected by kind of near-term factors. Clearly, some of the weather-related events in the United States affected the data, we think, probably in terms of the payroll number, and has been affecting certainly the claims data as well. I wonder how clean this number is going to be in terms of what it tells us really about the situation in the labour market. Yesterday's 10-year auction didn't go well. Does the 30-year auction go any better?
Yes, and it's interesting you put the claims number in the sense of how clean is that data going to be. I wonder how clean the auction is going to be, because the fact that we got so much corporate issuance yesterday, as we were discussing with Tunde earlier on, we got so much corporate issuance that maybe diluted appetite for some of that Treasury demand. if that's not the story today, if we're not seeing a whole catch-up on the week in terms of corporate issuance, then maybe the Treasury auction looks different, but we'll have to see.
Maybe go slightly better. It was really disappointing yesterday. I think it caught a lot of people on the hop. Tom Barkin's going to be speaking a little bit later on, Richmond Fed President Thomas Barkin, so we'll get his take on kind of where we are. It's interesting to get this Fed speak, given the speculation around whether or not the Fed is going to have to deliver outsized rate hike, 50 basis point hikes. CPI data out of Mexico. We've got that later as well. I think we've got a rate decision out of Mexico as well. And the corporate story continues. So you've got Paramount today, which I think is interesting. Expedia as well. Lilly's going to be fascinating, given particularly the misstep we saw, the marginal misstep, but it was exacerbated in terms of the share price move we saw around Novo Nordisk. So it's going to be interesting to see what they're saying in terms of their production capability to deliver some of these GLP-1 drugs into the market.
Yeah, is there any such thing as marginal when it comes to these businesses that are so priced for perfection in the views of some and so huge on the European corporate space? So Zepbound is the Eli Lilly contribution to this particular space, to the obesity space, and it has had supply shortages, which is something we've seen from some of the other providers in this sector. But the CEO has recently said over at Eli Lilly that they'll come to an end soon. So any update on the supply story at Eli Lilly is certainly going to be one that we're watching very closely.
In terms of the movers thus far, I think the house building story is interesting. I think Siemens is all over the place. I've seen it up, down. I think it's down again now.
Down again, now down 0.5%.
But to your point, the market's also lower, so you need to factor that into your thinking as well. There's a lot of ex-dividend in the market. The insurance story this morning, I think, has been really interesting. We've heard from Munich Re. Zurich Insurance has been a really interesting story too. Some really positive stories there, particularly coming on through in the fee business, which is much more sort of understandable and manageable in terms of the story there. So some really interesting corporate news coming up. We've also got some great guests lined up throughout the rest of the day.
Yeah, absolutely. We've got the Robinhood co-founder and CEO Vlad Tenev joining us later today. So that conversation, 3:30 UK time. That could be an interesting one. Back to where we started the programme then, guys. So we had Monday mayhem, turnaround Tuesday.
What have you come up with?
No, I'm still waiting. I'm still thinking. Whitsaw Wednesday. Well, it's only 8:56, so I feel we've got time. But this time tomorrow, we'll have a descriptor for Thursday, some alliteration. It all looks a bit gloomy right now, doesn't it? I mean, US
that
futures.
Doesn't work. Gloomy doesn't work.
Gloomy Thursday doesn't work, so we need a gloomy word that starts with a T. We have an entire team of top producers working on this endeavour this morning.
Yeah.
I hear whispers in my ear. None of them loud enough though to help me out.
We will come out with some decent names. I think it does hinge on the data a little bit later on. I think that's going to be really interesting, and how that is going to likely inform what we're going to see. So in a few minutes' time, Francine's going to be joining you for the pulse. What we'll do there is give you some of the early trades in terms of the single stocks. We'll get some pre-trade. In terms of US futures, this is what the picture looks like right now. We actually, when I first came in this morning, US futures were looking fairly positive. That has rolled over a little bit. Anna's been making that point throughout the morning.
Torrid. Thank you, Assad. Torrid Thursday so far. We'll see how it turns out. Thanks, everybody. This is Bloomberg.